us on inflation thing. This is the part of our initiative at EGROW Foundation to provide policy-oriented research and research-based policy advice to policymakers. This is the month when inflation targeting is under review, and we are making an attempt at EGROW Foundation to get the best minds of research with us. In that series, we have already had Professor Ravindra Dholakia, who spoke to us. And then yesterday we had Professor Pulapre Balakrishnan. Today we have Professor Ashima Goel. Next week we will have Professor Chetan Ghate. And then we will have Dr. Sujit Bhalla. With this, with the presentation today on flexible inflation targeting by Dr. Ashima Goel. Our chairman, Dr. Arvind Virmani, is chairing the session. So I hand over to Dr. Virmani to conduct the presentation.
Thank you, Charan. Let me give a brief introduction. Professor Ashima Goel is a professor at the IGIDR currently. Of course, I met her many times at IGIDR, but the last time we interacted was in the, interacted over a long period was in the high-level Monetary Policy Advisory Committee from, I think, 2013, for 3 years before the MPC was set up. So, and after that, of course, she has also been the member of the PMAC, the PM's Economic Advisory Council, and of course is currently a member of the Monetary Policy Committee. With that, Ashima, let me hand it to you, Professor Ashima Goel.
Thank you so much, Dr. Virmani, Dr. Singh, for the invitation. And I must congratulate EGROW on putting together a really wonderful series of talks on this hot topic for March. I mean, I think it'll, because in the newspapers you have a pretty shallow discussion. This is in depth, and I think it's a really good initiative. So before going into the current policy debate, I just wanted to a little bit touch briefly on the foundations of inflation targeting, because I think it's quite misunderstood often. So I want to talk about the evolution, where has it come from? And it's related to what I feel are the key kind of features, the way it can work in an economy like India. So then I talk about India's structure and what kind of inflation targeting can work here. So the evolution of inflation targeting came from this change from the real business cycle view to the new Keynesian multiple equilibrium view. Because in the RBC view, the idea was that markets work perfectly, there's perfect information. So the idea was, this quote from Karl Brunner is very entertaining, because he says that the training for a central banker was that you have to talk in a way that nobody understands what you say, because only if you surprise markets can you sort of affect real outcomes. While the NKE multiple equilibria view, which is the current dominant view among central bankers worldwide, Bernanke was a key exponent he really developed this whole theory, and he became the US Fed chief. So here, this is a quote from Michael Woodforth, that successful monetary policy is not so much a matter of control of overnight interest rates as of affecting the evolution of market expectations. So therefore, transparency is valuable. Yeah. And transparency means good communication. The rationale is that markets are not perfect. Individuals do not know the future. There's no perfect foresight. In fact, actual economies are non-stationary. There's learning going on. And therefore, central bank communication is important. It can reduce, it creates news. And in emerging markets, especially where other sources of news tend to be thin, the central bank says affects outcomes. There's a lot of research which shows how this can move asset prices, affect household expectations, and therefore move interest rates with less open market operations. reduce financial market volatility, etc., etc. So flexible inflation targeting, the rationale is this switch, the idea that you communicate something, and you can communicate, since macro is a very complex subject, you can communicate best if it's simple. So in India, for example, we went from the multiple indicator approach to inflation targeting, where you have two objectives, inflation and growth, but the focus is inflation, flexible inflation targeting. So the growth is hidden in the flexible and the focus is on inflation. But actually, all the macro variables that determine the objectives, inflation and growth, are still being considered. So it's a natural progression from multiple indicators to inflation targeting. And people think that nothing else is important. That's not true, because after all, inflation is determined by a whole set of considerations which still remain there. But the focus is on expectations, so therefore it's forward-looking. And the tools include the policy rate as well as the stance, neutral, accommodative, as part of the communication, and the explicit guidance on the inflation path. And it is rule-like, but there's operational freedom, there's accountability, and the idea of having a monetary policy committee is for continuity, for shared responsibility. It's a way of handling complexity. Because when you have independent experts with different perspectives, they help to balance trade-offs, to represent because the problem with inflation or macro issues is that there are a number of trade-offs between, say, inflation and growth, between a long run and a short run view, between the saver who would like a higher interest rate, the investor who would like a lower. Similarly, if you're a debtor or a lender, if you're a worker, you would like lower interest rates and higher, more jobs, vice versa. So you have to, and it's a way of representing different interests also and not being bound in some conflict of interest. So there is a lot to inflation targeting apart from just inflation. Then when just to consider the structure of the economy, an economy like India, can this work? A lot of people are very skeptical about that. And my own view is that since we have so much unemployment, and moreover, we are in a sort of transitional, people used to earlier say that development is different, macro is different. But when you are in transition, you're in a successful growth transition with a lot of migration from urban areas, as well as our demographic profile, where we have a lot of young people. So I think a long run aggregate supplies can be considered as somewhat elastic. Now, this is a very different way of thinking of the Indian economy, because, you know, the V.K.R.V. Rao, who is one of our founding economists, he set up D School, for example. He used to say that Keynesian economics doesn't apply in India because supply curve is vertical. You have so many problems on the supply side that there's no question of stimulating output through demand, and you have to expand growth. I think that thinking is still there, but I believe there's a major difference. We still have those structural aspects, but the way they play is that this aggregate supply, the bottlenecks tend to raise costs and push it up. So you have a volatile aggregate supply. Now, in such a structure, if there's some shock, we know that food and oil prices, all these, the difference from the normal Keynesian L-shaped supply curve is that this applies at any level of output, this rise in costs. If there's congestion, diseconomies, or rise in oil price is going to affect your costs, whether you're producing capacity or much below that. So therefore, this raises the supply curve all along its length. And this is a major cause of inflation. When there is a shock of some kind, which raises costs, then inflation is going to rise. Now, suppose you want to respond to inflation by reducing aggregate demand. Now, what is going to happen? It will have very little effect on inflation because the new supply curve is much higher, and it will have a very large effect on output. So therefore, this kind of standard aggregate demand policy or standard inflation targeting is not going to do very much to inflation. It's going to impose a huge output sacrifice. So what are the channels of monetary transmission? This aggregate demand, we just looked at it. That is not going to work very well in an economy like ours. There is the aggregate supply, but what can the central bank affect? It can affect interest rates, exchange rates, therefore aggregate demand. But it can't do very much about food and oil prices. But then the exchange rate is a variable that enters aggregate supply. And moreover, expectations also, because expectations affect wages, firm price setting, and therefore aggregate supply. So therefore, expectations become a variable where the central bank can affect inflation. And as we said, inflation targeting is forward-looking. It's about managing expectations. So this is the expectations channel of transmission, where, say, a fall in the repo leads to a rise in inflation expectations and inflation wages. Apart from the repo as a signal, there is also a guidance of, and inflation targeting itself has a long run target, which aims to anchor inflationary expectations around that. There is also a guidance on the path of inflation, which is very eagerly anticipated by markets. And that similarly affects inflation expectations. Now we know that the aggregate supply of Phillips curve looks like this. The New Keynesian Phillips curve, yesterday Bala was talking about this. So he says it doesn't exist. So what in India? That's not true, because we've done a lot of work on this. Biru, he was talking about Biru. His thing was that when you control for shocks properly, then you find that there's a standard aggregate supply with an upward slope. Otherwise, it's downward sloping. But I've done a lot of estimations of this, and I find that the slope is flat. This is the output gap. This lambda is very low. So it is flat, like that simple picture I was showing you. And then this muti are the random sort of cost items that affect it. And then you have inflationary expectations, expectation of future inflation. This is your core, or kind of trend inflation in the economy, which all firms expect inflation to be around that, and they will include it in their pricing. This is a reflection of firm pricing. Then there are other major shock for an emerging market can be country risk, where there can be sudden expected depreciation, which again raises costs or consumer prices and wages. So that's another kind of expectations of a rise in risk, which is particularly affects emerging markets. Now, with this background, let's see how flexible inflation targeting actually worked in India. So in the initial years, what we had, unfortunately, was inflation targeting, not flexible inflation targeting. The growth got hidden. The focus was just on inflation, partly because the idea was to bring inflation down. We were coming from a high inflation period. So interest rates were kept above the natural rates. And unfortunately, earlier, the Reserve Bank used to target WPI, switch to headline CPI, a huge gap between WPI and headline CPI. It was very high because of food price inflation and so on. So enormous tightening. Liquidity was also kept in deficit. There was no lender of last resort for NBFCs after ILFS collapsed. So there's a large output sacrifice, and inflation came down. So could you say that inflation targeting was successful? But in this period, in 2014, there was a large crash in world oil prices, and that played a major role in bringing inflation down. And despite that, interest rates remained high. So it all added to that. But the post end of, from middle of 2019, we have seen that flexible inflation targeting is compatible with the weight on growth as well as financial stability. In the COVID period, particularly when inflation was due to supply bottlenecks, first domestic supply chains were disrupted, and then now global supply chains, there's a cost push. So now the big question is that, is this transient? Can the MPC, for example, look through this? Or do you have to worry about it getting built into inflation expectations and actual inflation. So we saw that in the winter, food prices did fall. People were saying there's no improvement in domestic supply chains, but there was this large winter supply and some signs of reversal in domestic retail margin. Similarly for global supply chains, because COVID itself creates so much uncertainty. Oil prices are really rising, but in the long term, there are, easier sources of supply, such as US shale and so on, which will tend to keep prices low, and also a substitution away from oil towards green sources, which again should keep prices low. And at the same time, there's large unemployment and excess capacity, loss of jobs. So we have to increase demand, not reduce it. So although under inflation targeting, the repo has to rise with inflation, or it can, unless you think the natural interest rate can be negative to that extent, it can. Currently, our natural interest rate is negative. The real interest rate in terms of consumer inflation is negative. But then there are these other policy tools I was flagging, which have been used recently, such as guidance on the inflation path. That this is a temporary spike, that you can look through it, and that there is supply side action, as well as the stance, which is accommodative and allows liquidity to rise. So what is very important for flexible inflation targeting to work in the Indian context is some monetary fiscal coordination. There's a research paper in which I had shown that in India, flexible rules. So inflation targeting must be flexible. Similarly, the FRBM must be flexible, flexibly applied, and then it has a role. But when you have a flexible rule, then the personalities matter. Who is the central banker? Who is the finance minister? And in that, it's a game theoretic paper. It showed that a conservative finance minister and a pro-growth central banker give the best outcomes in an economy like India, where if you have growth, because in a catch-up period, you can have growth exceeding the real interest rate, and you need a primary surplus also. Then, anyway, and worldwide, this is being talked about now. Everybody is saying that. So I think foreign countries very opportunistic. They flip. So now it is more fiscal spending, despite really high debt, and Blanchard and other people have been. I think Ricardo Reis also was talking about this at an EGROW seminar, that interest rates are so low, they've been cut so low, growth is greater than R, G is greater than R. Therefore, governments can just borrow and limitlessly, and they should do that, because in a situation like this, the ex-ante deficit is larger than ex-post. If you spend and income recovers, your deficit could be lower. But for an emerging economy, unfortunately, borrowing costs are very high, and this country risk we were talking about can flare up. So here, careful increase in spending, the quality of spending is very important. And I think the emphasis on infrastructure spending, which tends to have a high expenditure multiplier. Again, there was a paper with a student where we'd shown that this expenditure multiplier is much higher, partly because of monetary accommodation. If infrastructure spending is easing supply side bottlenecks, and the monetary policy can be accommodating to this. So that's an example of coordination, which can then occur. Another way in which a relatively conservative fisc helps monetary policy is that it allows adequate open market operations to keep borrowing costs low. Otherwise, markets, currently we are seeing this flare up with a large, higher than expected deficit announcement, even though before that markets were always saying they need to spend more, they need to spend more. But when there was actually a higher fiscal deficit, then they're really worried about the borrowing, and we're seeing spreads rise. And the other problem here is that a lot of the space in the central bank balance sheet is taken up by foreign securities because of accumulating reserves, otherwise exchange rates would appreciate too much. So there's less room in the balance sheet to accommodate government securities. And that again is a constraint why you need a relatively lower fiscal deficit. But in general, both government spending and the interest rate needs to keep demand one step ahead of supply as supply recovers in the COVID-like situation. And we say there should be a large increase in deficits. Again, there's a paper I had in the IER on COVID, 19 and what policies. And there, the idea is that you can flip again the multiple equilibria, but all you need to do is a gradual. You don't have to suddenly spend a lot, but keep spending a little more, and such that demand remains ahead of supply. And you can gradually, the savings come, as income grows, and you can sustain higher growth. And another example of coordination is really using the financial sector, because again, there's a lot of pessimism about bank NPAs were expected to rise, but we've seen that there was a lot of reform and net NPAs were quite low, and monetary policy was effective in the COVID period, partly because it was reversing the tightening of the last decade, but there's still a lot of risk aversion. So the government credit warranties helped remove the fear of spending. So all this is an example of coordination. And why I'm emphasizing this I'll come back to why I think it's all part of the way inflation targeting works in India. But now the expectations channel, is it working? So long-term inflation target is well internalized. It is, people are like, I think yesterday Bala was saying that it works through wages and so on, Phillips curve, firms. But there are also rental contracts, there are markets. Markets pay a lot of attention to RBI views and guidance, and we've seen it affects bond spreads and therefore the rate at which corporates can borrow. Yeah. So stable inflation lowers country risk premium in the cost of borrowing in an open economy. The credibility of the central bank is important. Otherwise, you can have a shooting of this country risk. Has there been any anchoring of expectations over these last 5 years of inflation targeting? The standard definition is that expectations must be less affected by shocks. If there's a supply shock, household expectations don't rise. The inflation in countries abroad where expectations are well anchored, they're spending so much, and yet it's so difficult. Japan, it's so difficult for them to raise inflation. But in India, we're not there yet. And unfortunately, this period has also been one of very large shocks, unprecedented shocks such as COVID. And so you see some volatility in household inflation rate, and they've always been above actual. They're naive, they're not rational. Both the household and professional forecasters' expectations are naive, but research shows that there is a large influence of communication. And this coefficient is higher than in advanced economies. Again, because there's less news and hierarchy, means more attention is paid to what the central bank is saying. And moreover, this response is increasing in the flexible inflation targeting period. So the communication on inflation and the inflation target does seem to be having some effect. And what is also important is the inflation guidance. And here there's a problem because the forecasting has not been very good. So therefore, we come to the core title of this presentation, which is fine-tuning fit. So should the inflation targeting be core or should it be headline? Now, at the current stage, it's very difficult to really change anything fundamentally. It's basically about what the band should be and so on. But if you look at the RBI Act, where inflation targeting was introduced, it mentions that the RBI shall target a consumer price index, but it does not specify whether it's core or headline. So that's why I thought that it may be possible to just switch from headline to core consumer prices easily. The rationale for choosing headline was earlier than the period of very high inflation when inflation targeting was established. There was some research which showed that headline affects the core, or food prices affect industry prices. But again, research after that, I think Professor Dholakia has done, even we had a paper, in the EPW, we showed that, I have two papers in EPW, we showed that only when headline is persistently high and above a threshold, then it affects the core. Otherwise, and from the 2010s, causality has reversed, and it is core which affects the headline. Normally, a volatile headline, although supply shocks, reverts to a more stable core. And moreover, under inflation targeting, where forecasts are important for anchoring expectations, they can be much more accurate for core. And also, household expectations, again, some research paper we have in the Journal of Asian Economics shows that core dominates household expectations in the long run. And therefore, a stable forecast, we've shown that the RBI, even SPF, but RBI more than SPF has consistently over forecast inflation in this period. So now you are guiding people that short run, what you say about the inflation path is people are internalizing that, but you are keeping inflation higher than it actually is. You're not letting inflation come down. And moreover, because your expected inflation is high, you keep interest rates higher. And so we see that the household inflation expectations have changed, but they're quite volatile. And the forecasting also has been volatile. So a stable forecast may help reduce this volatility. And moreover, we find that the repo has a perverse effect. So the aggregate demand channel does not work well. And if you have headline, that's what Bala was saying yesterday, that the output gap, it doesn't work in India if it's, especially if you have headline, then squeezing output, reducing output, squeezing demand and reducing output, raising the output gap is not going to really lower inflation, headline inflation, but it will work for some parts of core where there could be excess demand. Now, what is the country experience? What kind of inflation target do inflation targeters have? In the early years, many countries started with core as a target. It was regarded as important to explain, to help people understand, because not only is the guidance on the target and the path, but also you have a monetary policy report, you have the minutes. All this is meant to help people understand how what the central bank is doing is going to affect inflation. And one reason there's continuing skepticism is that if you talk about headline inflation, then how does the central bank affect it? It's not clarified, the role of expectations also or anything. So if you target core, then it's valid to talk about an output gap and the aggregate demand channel. So it was regarded as important to explain what a CB can affect and to target that. But then headline occupies more mind space for consumers. And now as inflation targeting has been established, most countries target headline consumer prices, but it's important to suit the country context and experience, and it can change as these change. And many countries have changed. So I think in India also we could consider, we don't have to be stuck with headline because we started with it. For example, Korea had core as its target between 2000 and 2006. Thailand between 2001 and 2014. Most of the advanced economies started with core inflation. Brazil also began with core inflation targeting. Then also important is the measurement of inflation. It's necessary if you're going to use headline and the weights are 2011, 12, and very high, above 50% weight of food items. And probably with growth and the share decreases, but you are working with that base. So you need to improve if you're going to have inflation targeting the indices. And then people worry about a point of inflation and the data is so unreliable. We don't know what we are measuring. So it's necessary to update this frequently. And where the data is not so reliable, again, I think, and anyway, flexibility suggests an average is much better than a point. Another advantage of CPI core targeting is that there is less of a gap with WPI because there's more overlap, industry or producer prices which dominate WPI. And then it's closer to the most representative price level, which is GDP deflator, but that is can't be used because it comes with too much of a lag. Inflation, consumer and wholesale price inflation needs to be available at a higher frequency. Then there is also some fine-tuning possible in the procedures. Overall inflation targeting, as I said, that Phillips curve, that core inflation. Over the last 5 years, it's been about 4%, partly with some help from oil price shocks. But again, some research we've done shows that core extracted from an aggregate supply was around 5% in the 2010s. So this band is acceptable. But now again in the RBI Act, it says that the MPC shall determine the policy rate required to achieve the item. A policy rate is very limited, although it can be stretched to include the stance and forward guidance on rates or inflation. But I think there should also be some discussion on liquidity issues. In the Indian context, that's very, very important, how you are intervening, what is the space for intervening in the G-SEX market, FX market, liquidity. I think liquidity becoming over-tight created lots of problems in the last inflation targeting regime. And in general, it would help. When there are alternative ways of intervening and providing liquidity, then it has implications for the taxpayer, for how costly it is. So all that, there would be more transparency if there was some discussion. So I'll just conclude by saying that there are a lot of misperceptions about flexible inflation targeting, that it's only about inflation. But actually, as we can see in this period of major crisis and shocks, that flexible inflation targeting is compatible with paying attention to growth, to financial stability, and the whole gamut of other issues that affect inflation. It allows response to crisis, and its basic justification is from the presence of multiple equilibria. You can be trapped in a worse outcome when a better one is possible. Markets tend to overreact. Like one major, I think this government bonds market, major example of panic. And there's a lot of literature which says that, because if everybody's afraid rates will rise, everybody starts selling, then rates do rise. So again, so the central bank has a very major role to play. That is why liquidity, this lender of last resort, calming markets, communication. Markets expected more explicit guidance on OMOs, while the central bank, Reserve Bank, is more comfortable giving implicit signals. So there's a lot of scope for communication, not just about inflation, but other things. But inflation is key to anchor expectations. And what is the local structure and inflation process really matters. So then again, the misperception is the only instrument is the repo rate, that all the MPC does is change the repo rate. But the stance, the short-term liquidity, long-term money and credit supply, whether it's excess or deficit, and therefore impact on demand for short-term liquidity, guidance on future growth and inflation paths. Another misperception is that inflation targeting in India is all about response to past inflation, since it was introduced after a high inflation period. But it's intrinsically about preventing future inflation, anchoring inflation expectations. So therefore, in addition to the target, credible inflation forecast. Is there a question? There's some sound.
Please, everybody shut off your, mute yourself, please. Ashima, continue.
Yeah. So I'm keeping good time, right? I have about 40 minutes, yes? So
35 minutes.
no,
So
35.
you've got another 5, I guess.
Okay. So as I said, that in addition to the long-term target, credible inflation forecasts are also very important. And that is why I've argued that perhaps targeting core inflation would be better, because it is easier to make to make forecasts that are achieved. Well, you had a lot of misses in the forecasts in this period and it's inherently difficult to forecast headline inflation, where you can have swings in global oil prices or food prices or other kinds of shocks. Also, for inflation targeting to work in India, coordination with the government is absolutely essential because of that aggregate demand supply structure. And apart from the food and fuel shocks, currently we're seeing that taxes on fuel. When fuel prices had crashed during COVID, taxes were raised because revenues had collapsed. But now that fuel prices are really rising, taxes should be reduced, but they're not, because there's a game between states and center. If one reduces, the other will raise. That it needs to be brought into GST. But and these are all fiscal measures. Apart from that, this ease of doing business, the sort of bottlenecks we have, it's not just ease of doing business, but reducing the costs of doing business. Because there are all these indirect ways in which, like for example, this cross-subsidization between road and rail. So that instead of using much more economical rail freight, it's trucks, which diesel, oil, more costly, polluting, congestion. So huge indirect costs on the economy. So a whole lot of reforms basically have to continue, which improve the supply side and reduce costs. And if the government is doing this, apart from conservative fisc spending, not spending blindly, but spending on high quality infrastructure, etc., or health, education, which again reduces costs of production in India. So all that, there's a lot that the government can do. Unfortunately, in India, the structure is such that the RBI's instrument, the interest rate, affects demand more, and therefore output. We've seen that demand affects output with that kind of aggregate demand supply structure. What the government does affects inflation, and yet the inflation target is given to the RBI. So unless there is coordination, it's very difficult to achieve credible reduction in inflation. So thank you, I'll end there.
Thank you, Ashima. Let me start the process. Well, you've given your conclusions, so I don't need to repeat them, which are right there, still there. But let me raise one or two issues, and you see if you want to respond to them. So first, issue which came up when we were both on the advisory committee. I guess when we talk about expectations, we are talking about consumer expectations because we are focusing on CPI, right? And this issue of consumer expectations, at least as measured by RBI, being way out of the ballpark, and didn't make any sense to me. If I recall correctly, you also once or twice added the same thing, that these don't seem to have any meaning. So given that the whole theory and everything is related to consumer expectations, how do we make sense of it, or we just ignore them, or because when it comes to the practice, the whole focus seems to be on market expectations, which have nothing to do with the consumers. And this whole issue which has always puzzled me. So I would like to get your views on that. And second question is again an old conundrum. I mean, the agriculture till today, so we are still talking about past data, has been one of the most controlled sectors, whether it's domestic agriculture, exempt policy, stocking, etc., etc. So my old work, showed, which is ancient now, that we are disconnected from the world agricultural situation, and that may be a possible explanation why we have this big differential in the average inflation over so many years compared to, let's say, the developed countries. So these two broader macro issues. I don't see any other specific questions right now. So if you want to reflect and give your views on these two aspects, would be useful.
Yeah, I think consumer inflation, as I said, work shows that it's naive, it's not rational, and it is much higher than actual inflation. You're right, there's an absolutely, and this happened with the high inflation period, when food prices really rose. 2007, world food prices also, Indian inflation rose in that period. So consumer expectations do tend to overreact, they jump up, and then they don't come down very fast. But then but also, this is one of the things I remember I used to say at the TAC. They would always say price expectations are so high, and as you're saying rightly, it's not meaningful. They would also say that the level is not, it is an overreaction, but what they look at is a change. So what they were worried is that there's no change, and I would say no, it will change after some time. And suddenly, I think in 2016 or something, it did fall after 1 year. So it's not that it's absolutely constant, but as I was saying, it is volatile, and it doesn't have very much to do. Again, some current research is not yet final. We're looking at it. It doesn't seem to affect very much, but core inflation does seem to, in the long run, whatever the guidance you give has to be that core, which it does seem to converge towards core in the long run. These are VAR models, so a diagram will not show it, but the VAR models, which control with a number of other variables, do show. So these coefficients, these estimations suggest that the response of household expectations to RBI communication is higher in this FIT period. Yeah? So there's some impact on that. And you need a long period where inflation is low and there's confidence builds up. And unfortunately, we've had continuous shocks in this period of the day. In fact, that's been India's tragedy. In the whole period when we opened out, we had so many global crises, etc. Constant. But inflation expectations are actually much more than just households. As I said, bond markets and the spread. So that affects the cost of borrowing for corporates also.
Yeah, so the question, sorry for the follow-up, because as I said, would you say the market's expectations have become more anchored? I mean, I'm asking you for general thoughts. Don't have to justify every single, comment by data. I mean,
And I think that what the RBI says or does has a huge impact. There's a lot of analysis, discussion around it, and the path. For example, if the inflation guidance goes up, immediately you'll see bond prices rise. No? So immediately that will affect the cost of, that's the transmission, through market. Because another interesting thing about India is that banks, after that huge push for infrastructure in the 2000s, and then the NPAs and so on, after that, all this banking reform is about, they're doing really risk-based lending now. They're all switching to retail, like the private banks, to retail lending. And so a lot of corporate borrowing is through bonds now, the better corporates, even the NBFCs and so on. There's very public sector banks also are lending to micro, small small business, so many of them government programs. And in a way, those are less risky because it's not like you're lending 2,000, 4,000 crores to one person who collapse and run away with it. But so therefore, transmission and the cost of borrowing through bond markets is important. Apart from government borrowing, government borrowing is a major issue. I mean, 3.5% out of 13% expenditure is on interest payments. You know, the government can't spend much if borrowing costs.
Yeah.
And then
the
this
next
issue
one.
of agricultural. I agree. I agree that you know, I think China was so successful compared to India and its growth transition, because it started with agriculture, reforming agriculture, raising productivity. Unfortunately for us, and I think there's grounds for it. Like you're seeing with the agitation against farm laws, I think what we did in our reform process was we did the easy things on the financial side and so on, which the center can do. But land, labor, wherever large numbers of people are involved, there's a lot of resistance because some people will lose. You know, like Punjab farmers have grown up on those.
Let's leave the reforms alone. But what is there a link? Do you expect that if there is reforms, the inflation differential will come down over time, or not, or what? I mean,
Yeah, I think so. That is what I'm saying. That Phillips curve had shown with expected inflation, you know, which is just there. It's either sometimes you have these hybrid Phillips curves, lagged inflation as well as expected, and you work out on extract that trend, which is apart from the shocks, what does inflation come back to? So that trend, it's just something by itself. It's custom, it's habit. Its firms are used to keeping that excess. It's not required. It should come down. And that is where, you know, you work on that core. And one reason is these frequent supply shocks, food and fuel, and our vulnerability to it. Again, to compare with China, I mean, they were never as dependent on imports. They had huge exports before they reached our level of dependence. So again, we are vulnerable to global oil shock. But I like to think that there are global factors as well as this green, which is going to moderate the impact of oil shocks. And food prices also, we've seen MSPs, you know, I mean, some attempt at reform. It always used to work as a ratchet. The MSP would be raised and it would, you know, so we've seen.
Okay. Yeah. Thanks. So, Charan, do you want to have any question before I turn to the general, or comments or questions? You're still mute, Charan. Yeah.
I think there are a couple of questions waiting, but Professor,
Hello.
you combine.
No, I will do that. But do you have any question or comment?
Yeah, that's the point.
Yes, I have.
Yeah. So Professor,
No, hold on, please. I'm asking Dr. Charan Singh first.
yeah. So Professor,
The rest of you, please put it on the chat. I can see the chat. Please put it on the chat.
Professor, I have two questions, and you can combine it with the others, so you don't have to respond individually to my question, because I see so many other questions waiting. The first question, Professor, is from Harvard. Jeffrey Frankel had suggested that maybe nominal GDP is a better target than a core inflation. And he had his logic. Jeffrey Frankel's paper became very famous. So I do not know what your thoughts are on that. The second thing is, I have always thought most of the countries have gone for headline target and not core. And given the scene in our own country, where nearly 40 to 50% of the index has food prices as a component, if you only focus on core, maybe you're missing a very large chunk of it. I also say that because in welfare economics, at the end of the day, the consumer, how is the macro policy impacting the consumer is important. And if we take out the food component, and we know that in a country where poverty is so rampant, though they get food at the ration shop, but that's not the food they eat. It's much more rich, protein-rich food they've got used to. So would core inflation be the right concept? Those were my two questions, of course, correlated. Thank you.
Ashima, may I suggest you shut off the presentation so we can see the faces of people who talk? Can you?
Yeah, I have. Okay, I'll stop. I'll see if I can stop share.
Yeah, okay. Yeah, go ahead.
You want me to collect questions or answer?
No, please answer these, then I will go to.
Okay, yeah, sure. Yeah, just nominal. But I think that if you're focusing on an inflation target, there's this anchoring expectations and nominal GDP does not work. Is not as effective, but from the expectations channel point of view, but it does give much more freedoms to respond to shocks. And that is why I think that the flexibility is very important in inflation targeting, to have a long period and to target average so as to have some of that flexibility to respond to shocks that otherwise nominal GDP targeting gives. Then this issue of, as I was saying, it depends on, see, many countries started with core. Unfortunately, we started with headline. I mean, I think that in the beginning years of inflation targeting, you need to explain, for it to be credible, you need to explain how you are going to affect that. There's a lot of skepticism about inflation targeting in India because of the 60% food. How is the Reserve Bank going to affect it? Yeah, that I don't think even this current report on currency and finance, I really searched for some explanation. How does the Reserve Bank think it's affecting inflation? It's not there clearly. No, so if you start with core, no, then you can you talk about your output gap and so on. It's much more credible, no. And so, as I was saying, it's not that you have to do, and then the other research which suggests that household expectations are affected by your guidance, and it's difficult to forecast. So if you, and that forecast is also volatile. So if you have a more stable forecast, even though it's not the headline number, but it'll give a, it'll help reduce volatility in household inflation expectations.
Oh, okay. Yeah, let's go on. Dr. Nagesha, please ask your question.
Yeah. Good afternoon. Good evening, everybody. Ma'am, I'm very happy to know in India, actually, we have there is a wide issue of discussion. Inflation, real inflation is out of the box. What is being expected and what is real.
Yeah, there's some problem with your Dr. Nagesh, there's problem with your connection. So I'm just going to, I think, read out your question. Ashima, if you want to look at, I think he asked about the GDP deflator, which you kind of already answered. Okay, go ahead. You're back. Just quickly.
Yeah, sir. So just I wanted to know, is it the GDP deflator or something like a broadening of this inflation measurement? Can it address the respective aspect of the real inflation which is seen by the general public in the day-to-day price rise and the monetary policy target, or what is being anchored by the central bank? How to address this issue?
Okay, we'll take that question, and there's another one. Ashima, I'll just add this. Mr. Khan, MZ Khan, you can ask your question. Mr. Khan, are you there?
I can read his question. What will be the stance of the
go
RBI
ahead.
in the context of negative real interest rate faced by major today?
Right. Okay, go ahead. Then you can take these two questions.
Well, our interest rate is also negative in terms of consumer prices, but ours is negative because of high inflation. So it's the same thing. We have low inflation and much lower nominal rates. So our current real interest rate is also negative. But our problem is we have a large gap between different kinds of inflation. And this links to the question Nagesha asked, that we tend to have a lot of regional variation. WPI inflation has always been, at least the last 10, 15 years, much lower than consumer price inflation. Because of this food factors, Arvind was saying the agricultural shocks, which has been very, very, while industry markups or whatever, very low WPI. And one of the problems now in this COVID period is that you're seeing huge cost push and therefore WPI inflation is rising. Firm prices are rising, that core inflation is rising. Yeah. But this again might be transitory with these kind of, if it's due to supply chain bottlenecks. But ultimately, the idea of coming to anchoring, so anchoring to a long-term target is that all these types of inflation should converge. And of course, before the COVID shocks, research showed that there is convergence. The headline, which is volatile, does tend to come down to core. So headline influences CPI more. It comes down to WPI. Now, GDP deflator is a weighted average of CPI and WPI. And it's normally been lower because it irons out some of these fluctuations. But you need to work with CPI and WPI because it's available at a much higher frequency for setting policy and so on. So you get to know what is happening currently. Yeah. So that is why I think we need some kind of inflation targeting to bring all these different inflations into convergence at a low rate. Yeah.
Okay, Dr. Vishwandas, you had a question?
Yes.
Sure.
Thank you, Professor Ashima. It was a masterful exposition. My question has two parts. A, this FIT, you said the flexible inflation targeting, it has a bias in favor of the consumers, but not the producer in the context of the agriculture food prices. Now, for example, if there is a short-term supply constraint, supply bottleneck, then what is the government policy reaction? They stop the export of, for example, onion is a case in point. So it is positively biased towards the consumer and at the cost of the producer, that is the farmer's interest. Now, how do you see it? Because let the consumers also pay the rising prices for it. Why the producer farmer in case of food should bear the brunt? And you implicitly mentioned about the data quality. Now the frequency of data availability is changing very fast, and the change of baskets and the weights, they are revised sufficiently late time, say almost once in 10 years. So is it a good policy? Because at earlier good old days, it was relevant because we never get the opportunity to get the quick data. Now the technology is available. So should not you think that the base year should be changed more frequently?
Yes, absolutely, I agree, and that the base year needs to be changed, updated, especially if you are targeting inflation, you must measure it more correctly. And I think we miss, there are possibly overestimation as well as underestimation. Like we miss all those, this online, the kind of discounts that are given. I don't think we capture any of this. So there are some prices which are actually lower and others which are not. This hidden inflation people talk about, that the actual is actually much higher than what is measured. So biases could be in either direction, but we need to improve and make it more timely. And I don't know, given our advantage in technology and why we can't do this. So it should be easy to, there is, I think, Rigobon in the US, there is this lot of, they're doing it for a number of countries, prices through the internet and etc. But this question, as I was saying, there are these enormous conflicts of interest: consumers, producers, farmers. But for farm pricing, I think, like Arvind was saying, that this give farmers international prices. Don't stop them from exporting. Yeah, but then don't, for large part, MSP, for example, I think in some commodities it's now higher than international. And it serves as a ratchet. While it's the same thing with oil. International prices come down, Indian prices just keep going up. So that is what gives this upward kick to inflation. You know, like if you are going to say export, then you must also be willing to take lower prices when export prices fall. But you're not, then you want the government to come in and help you. And there is a rationale for that, that you build whatever you smooth volatility. Farmers actually benefit from less volatile prices, not necessarily higher prices. So insurance or buffer stock, but not huge, the kind of stocks that are built up for wheat and rice, which, you know, just a total waste. So I think we need to really improve. So different ways of diversification for farmers. So they're subject to these shocks, which is, yeah. But I think it's the poor farmers who are net consumers, they lose, you know, from very high farm prices. So where it's feeding into core inflation, it's very transient, the rise, because other prices are rising. So your consumption basket cost is rising, especially when it's poor farmers. Some more questions coming in.
Sharon, do you see any questions?
Yeah, there's one about weighted headline and core. So fine, that is all right, but the same criticism applies as Charan's criticism for core, that it's something unknown. It's not something obvious. It's not something explicit, you know. While everybody understands headline inflation, they don't understand core. But core can also be defined simply as just leaving out food and fuel, you know, not complicated ways of extracting core. You're just saying that it's price without this. So in a way, it's a combination of headline and core. The real is the current real interest rate negative? There's a question in India. So again, because of this divergence between price indices, consumer price inflation is higher than WPI. So while the savers are getting negative real interest rate, industry is still paying positive interest rate in terms of their producer prices. So, you know, we need these inflation indices to converge to know to have a uniform real interest rate. CPI has services in it. So this I'm saying target core CPI inflation, not core WPI inflation. So that includes services. It doesn't leave out services. Only thing it would leave out is fuel and food prices.
Food. Right. So I guess, you know, for those who are not familiar with it, the whole initial reason for defining core was that food and fuel were more volatile and more supply based and external shocks. And it was thought to be less connected to demand. I mean, that's kind of the original rationale. Ashima, you want to explain to the general?
Right. We just talked about this, no? That the aggregate demand channel, which is a standard channel by which the Reserve Bank affects inflation. No, it reduces demand, increases the output gap, which from the Phillips curve reduces firm prices. So that only works for core, not for food and fuel. Yeah, but this expectations does enter food and fuel also. So the expectations channel can affect headline also. But my argument is that where your guidance helps anchor expectations, the guidance is not very reliable. Forecasts are not reliable for headline. Forecasts would be more reliable for core. And if households are seeing a steady kind of guidance on inflation, which actually is achieved, that would help make anchor inflation expectations, make it more credible, make inflation targeting.
Thank you. Okay, Charan, I don't see too many questions unless you want to add some. Do you want to ask some of the questions which
No, I've seen the chat. I've seen all the questions on chat. I've answered those.
Yeah.
Right.
So, any additional apart from that?
Yeah. So the question I guess in the review of inflation targeting, I guess some of the things you already answered. The other questions related to the price band, and how to use it in the sense 4 ± 2 or 2 to 6. That was one issue. I think you already answered the core versus this. So that the other one, the price band is and sorry, I should add, is there any need? I mean, when you say flexible, is it any need for it to be more explicit regarding the GDP or output? These two.
I think the RBI, if you're going to stick with headline inflation targeting, then the RBI suggests instead of 3 quarters, it should be 4 quarters. No? So that sort of flexibility should be given then, because these are very volatile, and also our price indices. We must measure headline. It must be more recent, because the weight given to food is so large in 2011-12. That must have come down, but we're continuing with the 11-12. So especially if you're going to stay with headline, then you must measure it more current weights, and then you should give more time for shocks to play out. Especially in the current situation where you need to support growth, but there's all this problems with supply chains, and these are supply constraints that are affecting inflation. So, yeah.
Okay. Well, I think with that, let's conclude. I think we started late and it's a Saturday. Charan, you want to make any? And thank you, Dr. Ashima, for joining us here. Charan?
Yeah, there is this question by Nagesh in the chat box. Do you want to answer that, Professor?
We've answered questions, Nagesh's questions already, nahi? I think 2 or 3.
Yes, that was the first question.
Yeah.
We're broadening our inflation measurement, core versus headline GDP deflator.
Yeah.
So he's just asked, where does the number 4 to 6 come from? And is it
that's a new question.
Yeah, he's just asked another question.
So as I was saying, that this core inflation is a trend or underlying inflation, and I was showing you that Phillips curve, that inflation. So if you estimate that, we've done that, then the value we got for 2010s earlier was 5%. Just recently, in this 5-year period, RBI has done some analysis where they work out the inflation trend, and they see that it's about 4%. Using different inflation indicators, GDP. So that suggests that the core, that is a valid kind of central point to have for your inflation targeting. And then you have shocks that raise it or reduce it.
So that would be for the core, right? Yeah.
No, this is for headline currently.
Oh, this is a headline. Okay. Yes, I think somebody else also mentioned, you also mentioned earlier. Yeah. That's a good point, right? Okay. Sorry, Charan, I think I'm going to conclude now unless you have some other things. Yeah.
Sure, let's conclude. I must thank Professor to have agreed to speak on a Saturday, and very kind of her. And we have seen how beautiful the presentation has been, starting from the basics to the real hardcore issues that we have just discussed. So thank you, Professor, for having agreed and delivered this talk at EGROW. The recording will be available tomorrow by noon. I'm sure you will be able to use it in your class. That's the side effect of the EGROW seminar. And I'm sure, I know that there are others who do use our seminars for classroom discussion. So I'm very happy that.
I think anybody who wants to understand inflation targeting should, read this month of March. You got a really range, different perspectives, so very well-rounded, all aspects. Excellent public service you're doing.
You are our advisor. And
Yeah.
next week, we have Chetan Ghate, Professor Chetan Ghate, speaking about agriculture prices and inflation targeting. We have just noticed in the last two discussions, agriculture prices keep coming up. And so Chetan Ghate is going to speak specifically on that. So I welcome each one of you to please come and participate in the discussion next Friday, 5:30 to 6:30. With this, once again, thanking our chairman, Dr.
Okay,
Virmani,
thank you.
and everyone else to have participated in the discussions today. Thank you so much.